Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where we look at the week's financial news that can be a bit confusing, misleading, and take you, of course, way up to make it actionable, understandable, and clear. Ooh, what a week of tariffs, and therefore what a show about tariffs and other things. But we are going to get into it. As of this recording, markets are going down, and dare I say down again. I'm looking at the United States market, down about 4.28% in one day. International down quite a bit less, down about 1.6%. Some individual stock names just getting hammered. So this is part of the great challenge of owning individual securities. As I reference, you can have some very rough days. So it's just can be so difficult to pick which stock will do well on a certain day. But boy, howdy, Amazon down almost 8%. Valero, the oil refiner, down 13%. Wouldn't you know it? Berkshire Hathaway not down that much. Mr. Buffett with as much cash on his balance sheet. But we're going to look at these tariffs. We're going to observe the behavioral things we should be focused on in order to ride through this time, but also some of the nuts and bolts of what's a tariff, why does it matter, why are the markets selling off, and then what strategies do I, Robert Hunt, use to push through some of the noise, and then a bit of a warning on what is to come. So we've got a couple Wall Street Journal articles on tariffs by Nick Timiraos and James McIntosh. We've got an advertisement to watch out for, and then some kind of individualized help with how do I push through the noise. So you may be feeling a little off if you're an investor that watches the markets and watches the news. I want to start with a strategy I use. So as I referenced, American markets down considerably. Wouldn't you know it? Bonds are up. Bonds are up. Everybody thinks owning bonds is boring, but wouldn't you know it? Boarding's not so bad. BND, the Vanguard, basically essentially total bond index, up 0.61%. Vanguard's municipal bond fund, VTEB, up 0.60%. So listener, you do see perhaps in days like today, bonds have a role. Bonds have a role. Cash has a role. It's just not a drag on your returns. It's a bit like an insurance policy. But I want to start with, let's look at dividends. Amidst this carnage, so they say, something occurred at the end of March. That was our first quarter dividends. This is how investors should think. None of this price action up and down business. What did your holdings produce for you? Remember, we want to think like a farmer as an investor, not like a speculator. So if you own land and you're farming, you're interested in how many bushels of corn and soybean and wheat did I create and was I able to sell to the market? That's the value that the farm brings to you. You're actually not every day considering, well, do I sell the farm or not? Do I sell the farm or not? You're not listening to speculators. That's what the stock market is. It's yelling prices at you. Right now it's yelling lower prices at you than it did the day previous. It's yelling prices at you, but let us dig in. Let's see what sort of crops were produced from, say, Vanguard's S&P 500 fund. Now, this is a mystery to me. I need to call Vanguard because I actually don't understand something. And they might not either, but listener, if we might crowdsource this thing. Did you know there's a discrepancy right now on the dividend payment given for VTI, which is Vanguard's total U.S. stock market index. It's got essentially 100% of the stocks in the U.S. stock market in it. And VOO, which is the Vanguard 500 index, okay? And the discrepancy is in the Vanguard, the March 31st, 2024 to March 31st, 2025. I want you to think about, what do you think the growth rate was in dividends for the S&P 500? Again, I'm doing year over year from March of 24, end of March of 24 to end of March of 25. What do you think that growth rate is? If you guess 17.5%, you were correct. That number should floor you. Like pick yourself up off the floor you. The idea that a dividend year over year would increase that much for the S&P 500 is bananas. It's wild. I went back. Okay, well, it was $1.54 per share in March of 24, $1.81 in March of 25. So if you're a farmer, not a speculator, you can look at this data and say, fantastic. Oh, people are selling off. Whatever. I just had the greatest harvest, the greatest increase in crops. given to me in ages. Now, here's where I have questions and I want to evaluate with Vanguard. VTI, by the way, which is 80% of what's comprised of VTI is the S&P 500 index. So VTI, 80% of that is essentially VOO. Okay, does that make sense? So these are market cap weighted indices. So the bigger the company, the higher the weighting. So VTI, 80% of that is the S&P 500. What would you think the year over year growth rate in dividends is for VTI, which is almost the same index? It's got 20% difference, but that's nothing. Believe it or else, it's only up 7.7% year over year, which sounds right. That's a more normal figure. It's still high, but year over year, March to March, end of March is up 7.7%. That's still something to celebrate. Wow. Incredible. If you're thinking like a farmer, you're high-fiving, feeling like a winner. How are your investments doing? You just tell people they're doing great. I couldn't be more pleased. Up 17.5% year over year on the S&P 500, and then I'm up 7.7% for VTI, which is all the stocks in the U.S. Wow. It's incredible. Now, I'm going to dig in. I'm going to dig in on this S&P. I'm going to hopefully figure out this discrepancy. But these sorts of data points can help me, and maybe they help you, ride out the volatility. Believe it or else, did you know that I'm affected by the volatility? You think I'm some big tough podcaster that isn't immune to the vicissitudes of the market? No. I look at them and I think, what is going on here? Is this forever? And I want to highlight what the Wall Street Journal has put together with these tariffs, because I reviewed the tariff chart President Trump threw up. I'm looking at experts, and we're still trying to make sense of it. I still can't make sense of how some of the figures were derived. This reciprocal trade business, he's treating a trade deficit, meaning the difference in the value of the goods imported and exported. He's acting like that's some sort of a manipulation thing. So definitionally, I probably have some differences with the way President Trump characterizes trade and the benefits of trade. Trade is a very good thing, listener. And actually, the reason why the market's selling off is it's going to be more expensive for these companies to operate. It's a tax. So these tariffs are tax. I'm kind of showing my hand a bit. Perhaps it works out. I think there's always a chance. But let's listen to one of these articles. Headlines: Trump's tariffs aim to create a new world economic order. The announcement Wednesday stunned markets. You bet it did. It could also push countries, including the U.S., to the brink of a recession. All possible. This is Nick Timiraos. He says the U.S. is moving to blow up the global trading order it built, ushering in an uncertain new era. I think that's true. Now, we don't know how long it'll last, but listen, this is what stunned the markets, because the markets were not predicting this. That's why they're dropping so much today. They would have dropped earlier if they thought this was going to happen. The article continues: Trump stunned markets by announcing a suite of tariff hikes on major trading partners, including 20% for the European Union and 34% on China. The tax on imported goods, which also includes at least a 10% across-the-board increase on every country, will raise overall weighted average tariffs to 23%. That's the highest in 100 years. So it's referencing these other periods in history when major economic changes were made. They talk about Nixon in 1971, this post-World War II order that was created. He started to roll back with some of his changes with the gold rate. They're saying this is analogous. And the article says it's a bit chaotic. A quote here that I found interesting. This is Stephen Blitz, the chief U.S. economist at Global Data. He said they just announced a major tax hike, mostly on the corporate side. But as with most corporate taxes, they will be translated to higher prices to the consumer, and you don't grow an economy with higher taxes. Yep. I think that's all true, listener. Higher taxes are typically not the friend of cash flows to corporations and businesses and economic dynamism. They reference some of the real, if these tariffs hold and there's not a negotiation, they talk about a company like Nike, which produces half its shoes in Vietnam. It's a 46% tariff. Various consumer electronics will face 25% from Taiwan, South Korea, China. And the risk, they say, this is where the market is spooked, that inflation could definitely kick in, and simultaneously the U.S. economy can go to a recession. Yeah. It's a worst case scenario potentially if that occurs. That's stagflation. Stagnant economy and increase in price of goods. No bueno. For my listeners in Spain, no bueno. So there is new revenue. The tariffs do bring in new revenue. But this is a big old wet blanket. A big old wet blanket for asset prices. Because if they stay, it is essentially a tax. Now, it could work out. It could work out. Listener, let's remember, anything can happen in the future. We have no idea what will happen. But part of the dynamism of the American economy, wouldn't you know it, is that when we buy something from Oklahoma into Texas, there's not a tariff. When we buy something from Louisiana and Texas, no tariff. And vice versa. So we have an economic trading bloc called the United States. And what President Trump is trying to do is increase the dynamism of that bloc and ensure that we build our own industrial base. It could work. It could work. The markets are saying, I don't like this. And I would agree. Unless it's difficult for me to make, we're early, but it's difficult for me to make sense of the tariffs. Difficult to make sense of who we're putting tariffs on and why, the amount of the tariff. I don't quite follow the reciprocity that is being purported by the administration, saying, "Hey, we're tariffing you this because of maybe I will in time. Maybe on future episodes you'll hear me do a 180 and say, aha, the tariffs make sense, the numbers make sense." But what I look at today, it feels like we're just electing we just want tariffs, and it doesn't matter how we get them, we're going to have them, and it's going to make doing business more expensive for people because it's a global economy. So, investor, as always, we got to ride it out. This is why that time horizon's got to be extra long on days like today. Extra long. Control what you can, what's your cost. And then the beauty of simplicity in investment is that you're not exposed to individual securities. It is a very difficult game. For example, today, the price of oil dropped considerably. So any sort of oil and gas exploration company, particularly oil, because natural gas is up today, believe it or else, those stock prices are hammered. Absolutely hammered. James McIntosh, this article, Market Upheaval from Trump's Tariffs, could be just the beginning. These are the articles you might see that are going to test your nerve as an investor. So you've got to push through this stuff and realize you're going to want to keep owning stocks. Do not try to play the game of predicting when President Trump will put tariffs on and pull them off. I don't know. I'm not sure he knows either. So the idea that we're going to get into his head is an impossibility. So do not think you're going to be able to pick the bottom here. It's not going to happen. But Mr. McIntosh has a funny thing. Is recession now spelled T-R-A-I-F-F? Haha, tariff. So he's saying similar stuff that he's looking in the bond market with junk bonds saying, yeah, some of these junk bonds are selling off. Some of these bonds with a less stellar credit rating it's not looking like, they're predicting that we will enter into some trouble as an economy unless something changes. So what this gentleman kind of sets us up for, Mr. McIntosh, is he says, if you're an investor and you think the return to tariffs higher than, and again, this is 1930, the Smoot-Hawley rates will hammer the economy into recession. If you think they'll hold, basically, the stock market will drop way more from here. That's what he's saying. If you think this is transitory and we will see, negotiations will ensue, you're going to be just fine no matter what in that scenario, because then tariffs are really just a negotiating tactic, which could be the case. I walked down memory lane, that 1930 Smoot-Hawley. A lot of historians point to that act and those tariffs as leading and pressuring Japan into being an empire builder. As an island nation, you'll remember they desperately needed trading partners. And in a world where there was a tariff war globally, their leadership decided, okay, we're going to go secure resources on our own. So tariffs we must be very careful about tariffs. And the United States, of course, in hindsight, realized that. They didn't think at the time, at the 1930 Smoot-Hawley rates, that would kick a can of dominoes and all of a sudden you'd have Japan invading mainland China. But we must be very careful about just throwing tariffs around, as President Trump is. Let us hope that he's got a plan. He may. And something to be careful of. So when market volatility like this kicks in, when markets are down big, here come the advertisements for safe, secure investments that are immune to volatility and only give you positive returns. I had one on my X.com feed by Mr. Sawyer Donnell from New York Life. Market's got you down, he says. Earn a guaranteed 10 to 12% in year one with a fire symbol. You have until April 30th to lock in this opportunity, plus enjoy a solid rate in the following years. And then a quote. So he's appealing to our intelligence here. He says, the time to buy is when there's blood in the streets. That's Nathan Rothschild. And here, click the photos to sign up. And here it is. For a limited time, earn 12% for the first year. And here's a smaller print. And 5% each year thereafter on assets in the premium deposit account of select whole life policies. Whole life insurance. So not a good product for you. An excellent product for Mr. Donnell. There's some very rare instances where whole life is appropriate with estate planning. But by and large, it should be avoided by just about everybody. It's a wonderful product to earn a big old commission on for the sales force that pushes it. Beware. This is just the beginning of what I suspect will be a bombardment of safe, secure investments in these troubling times. You must keep your nerve, investor, and you must know your stuff. I also think it's a wonderful time to reassess your risk profile. Many of us overinflate our risk tolerance. Some underdo it, but many of us overinflate it and say, a correction doesn't bother me. Stocks could go down 50%. It wouldn't bother me. Okay, imagine what happened today happening every day for the next 10 days. Are you good? Do you feel solid about your investments? Do you feel like your risk profile is appropriate? Your balance sheet's intact? You have adequate cash? These sorts of market feints can be clarifying and perhaps help us get out of our stupor from a risk management standpoint. So I'm not advocating any sort of immediate changes, but just be mindful. Be mindful of the way you think about this and be honest with yourself. Hey, if these tariffs stay in place for the next, for the duration of President Trump's term, it will certainly be very difficult for the stock market. Very difficult. So amidst it all, let's bring it back. Let's control what we can. Let's keep our cost low, our investing simple, and our time horizon long, because that's what's going to give us the best shot on our investing journey. Take courage, investors. Until next time.